Good evening, everyone. Hope you're doing well. I know it's been a while since my last video update, and some of the trends we've been looking at in markets are playing out sort of as we expected. Because it's been so long, what I might do this time is just focus on stock markets, and I'll do a separate video in the coming days or weeks on the bond market, what's happening in precious metals, that sort of thing. There's a lot of interesting things happening. I've already drawn on some of these charts, but let's start with a clean chart of the US market, the S&P 500. This is a daily chart. And we can see a bit of a breakdown as we were sort of forecasting in the charts the last couple of months. You can see the S&P making higher as S&P 500, sorry, making higher highs while the momentum indicators, the MACD and RSI trending down, so negatively diverging, giving us a sell signal. There's a few ways you might want to draw an uptrend. You might want to say, well, this was the uptrend here and it was broken. I wouldn't draw it there because it only touches the two spots, but clearly, this level around sort of 58.70 was very key. You had that at the time that was an all-time high. You can see the breakout, the low there, the touch there, a brief break below, and now it's sort of really struggling to hold this level. Now there was a bit of a bounce last night, but there is some indication that that the market is weak, that the uptrend is losing momentum. And of course, if we go to a 5-year chart, well, it doesn't look like there's much happening there. But you can see again, as the market has been trending higher, negative divergence on the momentum indicators. That's always a sign, generally a sign that the uptrend is losing momentum. You might say from the low I think that low in late October was very key for a lot of markets. And you can see if we zoom in, you can see it's threatening. Now that's a weekly candle, so the week's not over yet, so it could recover back into the green. But the US market is threatening to break down. We'll have a look at some further charts. If we look at the Nasdaq, the technology index, and if we go to, I believe I've been looking at this on the daily. You can see uptrend from August 2024, so roughly 6-7 month uptrend, as the price was making a double top, negative divergence on the momentum indicators. So again, a sign that, when a market hits an all-time record high and there's negative divergence and it's had a great run, even from August, the low in August to the high in December was a 27% move. These are fast moves. This is why in previous videos I've talked about how my clients and I are much lighter in stocks, much heavier in bonds and gold, that sort of thing. And to the extent we have stock market exposure, it's mostly in covered call and high income funds. Again, I don't know if that's appropriate for you, just letting you know factually what my clients and I have been doing. And I've talked about this in previous videos, and I would say that strategy's worked reasonably well. We do have some small short positions on the market, so some of us are up 8 or 10% on those positions. They're slightly leveraged, but small positions. Again, we're not high risk traders. We are longer term investors, and we just manage risk by adjusting our allocations, our trade positions, that sort of thing. But you can see with the Nasdaq, this level here, this sort of around 20,600. That was an all-time high in July, and you see it broke out, it bounced from there, and now the recent move down has taken out that low. Now, I know there's a bit of recovery there, but that's typical. You normally get a little bit of recovery, and you sort of roll over like that generally. So I wouldn't be aggressive. It's hard to say. This thing can just bounce back at any moment, but we are seeing further signs that major tops have been put in US stocks, and I am certainly exercising caution. This chart here is the future Nasdaq E-mini futures, so a market that would trade through the night, and you can see the breakdown is a little more obvious in futures trading. You got the double top there. Now it wasn't a double top until it broke that low, but you can see that high from July, the breakout, the bounce, and then on the sixth attempt, through she goes, and trading below that level now. So this is reasonably bearish price action. Again, I've deleted the line there, but you can see as the price was making roughly the same high, negative divergence on the momentum indicators. Again, that's a sell signal for me, excuse me, or an indication that the uptrend is certainly losing momentum, and we're seeing that now. So this chart here looks pretty ugly, and if you want to draw an uptrend, you'd say a touch there. Maybe I would cut those candles a little bit and say you got touch there, look, up she goes, and then the breakdown, the retest, another little retest at the previous high, and down she goes. So the price action for me is looking pretty bearish. I'm not calling for a massive crash. Again, I think central banks will come to the rescue. They will stimulate. We're seeing the European Central Bank is about to cut interest rates for the sixth time. The Federal Reserve has been cutting. They shouldn't be cutting. I don't think the inflation problem is solved. But you know, governments are going to prop up stock markets, and that's a terrible thing. But a lot of the gurus out there are calling for an 80% crash on the Nasdaq, and it's not 1929 anymore. Money is very our financial system is completely electronic and digitized, and central banks can at an hour's notice print trillions of dollars, prop up markets, buy bonds, I mean, in some countries like in Japan, they already buy the stock market, they buy ETFs. So um, I wouldn't be looking for a massive crash. All I'm saying is that this thing has run very hard, and it looked very expensive for a few months there. If you've watched my previous videos, if you're a client, I've been talking about that. And again, the Nasdaq now is effectively, let's go back to the actual index. You can see the Nasdaq is today at the same price it was in July. So we've had over the last 8 months, there's now zero growth. Yes, if you bought the low, you've done well. But if you look back to where the price was on the 10th of July, same price now today. And now the dollar index, now this is going to be a messy chart. I've drawn a lot of lines on here, but hopefully you can follow this. I've looked at these charts before, but the US dollar is trading very technically, and I talked about how it was topping back in January, or probably in December. I probably called that it was topping a little bit too soon, but you can see, back in August, if you watched my videos then, my clients and I were going long the US dollar. It was in a falling wedge pattern with positive divergence on the momentum indicators, broke out, had a great run. I probably sold it too early. I was selling for clients around here, thinking, okay, well, it's hit this previous level. At the time, I'm looking at this and going, okay, that was a level to get out of that position. Of course, I got out too early, but I do think it was appropriate to be long the US dollar at that point. And, I'm not a long-term US dollar bull. I was just buying it as a hedge, to diversify my clients' portfolios. Generally, a rising US dollar puts pressure on other asset classes. I think that's been the relationship with bonds, certainly over the last year or so. With the dollar going up, bond prices have been going down. My clients have a lot of bonds, so buying the US dollar was also a way to hedge that longer term allocation that we have. And of course, again, very classic. There's so many notes on here because this is classic trading behavior. We can see the big uptrend, and then around November it started forming into a rising wedge. Remember, a rising wedge pattern is generally bearish. It's generally a sell signal. So you had the rising wedge, negative divergence on the momentum indicators, if you can see all that amongst the mess of my notes. So as the price was making higher high, momentum indicators making lower highs. Again, that's another sell signal. Had a spill out of the uptrend. Look at that big red candle spill from the uptrend. That's another way that tells me that that trend line was somewhat valid, because it was, look how many times it touched that line on the way up, and then when it broke with the big red candle. So heavy selling, traders seeing the breakdown, selling the dollar, and then you might not be able to see, but there was a big spike up intraday, got back to that 110 level again, just to test the double top, to test the breakdown. You can see this dotted line I've drawn that I should now make a solid line. It's forming a new downtrend, touch, it found support at the previous key high. You can see there again, some more support. So that was a key level at 107, roughly 107.50. The breakdown again comes back to test. So it tests not only the support line at 107.50, but the new downtrend line that it's already touched 1, 2, 3, and then a fourth time. And then we can see confirmation of the downtrend, a big spill. Look at those big red candles. That's some pretty negative price action in the US dollar. Now, I'm not buying the US dollar yet. I don't see now. It could very well just bounce from here. It could just go like that and bounce straight back. Very well could. But I don't see any indications on the chart that the US dollar is a buy for me yet. This is no man's land. Now, if it gets back to, clearly the 101 level is very sort of key long-term support. In fact, if we go back to a 5-year chart, it's going to look a bit messy, but let me hide my notes. You can see that this level around the 100 or the 101 level, if we draw a line here going back to 2022, it's trying to hide my stuff, and I guess when I draw that, it brings it back on. But you can see that level there, I'll just leave the cursor there. You can see that 101 level, every time it gets down there, it's been a buy. So if it came back down to that level, sorry, every time I draw something, it comes back down to this level, continues to trend down, I'll look at it again as obviously I'll assess the charts and the market conditions at the time, but that's probably going to be an appropriate level to buy some quote long US dollar funds. I can't give investment recommendations on this video, but if you want to know some of the ETFs that I buy to go quote long the US dollar from the perspective of an Australian investor, there are a couple of choices. I do have a preference for one or the other depending on market conditions, but look at on the weekly chart, that big red candle, that is a pretty significant sell-off in the US dollar. We saw the last time we've seen a candle that big was back in 2022, and of course the US dollar continued to trend down from there and took quite some time to recover. I mean, it didn't even get back there in 2023. It really took another 2 years or so to get back those losses from that last red candle. So I wonder if we're going to see that again. I don't know. What's unusual is the big spike in the euro. And again, let's have a look at some of the same technical patterns we look at all the time. Back in August, September last year, you saw a double top on the euro. Let's come back over here. So this is euro against US dollar. Saw a double top in the euro, negative divergence on the momentum indicators. We know what that means. Double top at a previous high, negative divergence. That's a sell signal. Of course, down she goes. You had a bear flag. That's a bearish signal to get a flagpole with a flag like that, a rising sort of broadening wedge. That's bearish. And of course, it broke down, sold off. And then we got the opposite signal around Christmas last year. You can see it started to go into a falling wedge. Then there was positive divergence on the momentum indicators. So as the price was making lower lows, the MACD and RSI were making higher lows, positive divergence. That's generally a buy signal. Again, you shouldn't just use these signals on their own. Pair them with other forms of analysis. You see the falling wedge, that was bullish. And then again, we can see the validity of the wedge because look at what happened when it broke out of that line. You can see a big green candle. So the traders see, okay, this is the breakout, and everyone jumps in and buys. And then we get the classic move up and then the return to the scene of the crime to test the breakout there. Again, this is straight out of the textbook. Rallies back, struggles to make a new high. And then the last 3 or 4 trading days, big green candles. Now, I can't tell you exactly why we've seen this big spike in the euro and the big drop in the dollar. You can speculate. It's probably got a lot to do with the tariff situation. Some of the US government, for lack of a better term, quote, negotiations they've been engaging in, both on tariffs and with Zelensky. That was, we probably won't get into that on this video, but you can judge that one for yourself. Look at the markets, look at how financial markets are reacting, look at the way the US dollar has reacted the last couple of days. Clearly, the market is not liking America at the moment. So let's now move on to the Aussie market. I've been going for a bit of time here, up to nearly 13 minutes. I'll try and hustle it along. Again, we've looked at the Aussie market, and it's, again, classic trading action. I mean, I talked about how, back in December, the Aussie market hit an all-time high. When a market hits an all-time high, and of course, even back then, I haven't drawn it on this particular chart, but even back then, there was negative divergence on the momentum indicators. You can see price making higher high, momentum indicators not hitting an all-time high price. You shouldn't have a high allocation to an asset class that's hitting an all-time record high. All-time record high means it's the best price you've ever been able to sell that market. That doesn't mean you go short or bet on a crash. It just means you lighten your positions a bit, and that's what we did. And of course, we had the spill. You can see this 8,100 level was pretty significant on the Aussie market. It was a high in July, a high in September last year. Once it broke out, you can see lots of bouncing along that level. So that's a buy level for the traders. And then we ran up and made another slight all-time record high. But again, you can see the momentum indicators continuing to negatively diverge. So again, hitting an all-time high, that's another sell signal. And my clients and I did open some short positions around this level. And I'm pleased that we did because we saw the spill out of the uptrend, and the Aussie market's been looking very weak. Now, I've drawn 2 lines here because I think the key level is this 8,100 level, but just because we trade below there for a couple of days like we did back in December, just before Christmas, doesn't mean it's a clear break. So that was a false break of that level there, and you can see a low at 8,050. And today's action was pretty weak. You can see the Aussie market is breaking below that and closed at 8,094. So closing below that support level, but I would say this level is still key. And it hasn't broken yet. So I'm not looking necessarily for a big breakdown in the Aussie market. Sorry, let me just check my software for a bit there. There we go. I'm not calling for a big breakdown necessarily. This level could still hold. We could just come down here for a couple of days and go right back up to an all-time high. but this is looking a little bit precarious, isn't it? I mean, it's looking like, I mean, we could easily spill out of there and go back to 76.50. Back to, there's a lot of support at that level. You can see if we zoom back a little bit further around this level, 76.50, lots of support there. You know, look at the high there, the consolidated trading action there, again there, bounce, bounce. We could very easily be heading there, but it's uncertain at the moment. Um, if I was an aggressive trader, and so now that we've reached this level, I've started increasing my clients' allocation to the Aussie market very carefully, not massive increases, but we've been doing some buying. Keep in mind, we do also have some short positions that we opened at higher levels, so that short position is protecting us a little bit. We've got a little bit of insurance, but down here, it's time to do a little bit of buying, with the view that we could easily spill another. What's that in percentage terms? Let's find out. We could easily spill another 5%. And if we did at that point down here, I would be increasing allocation again. If we look at the Aussie futures market, this is a little bit more of an interesting chart. We can see, this goes back to January 2024. So we're looking at just over a year's worth of data. You can see an uptrend in the Aussie market. Now, this is a weekly chart, so this candle has not closed for the week yet, so it could easily recover. But you can see on this chart, it's looking like we made higher highs, negative divergence on momentum indicators, and now we've got a candle, a big red candle 2 weeks ago, and now we've got a big candle spilling out of the uptrend. This is not a positive sign. This is a sign that the uptrend is breaking. And if we look at, just briefly now, we'll finish this up in a sec. Looking at the Australian banks from October 2023, remember I said earlier that I thought October 2023 was a major low for some very key markets. And the Australian banks, the XFJ, which is the financials index, you can see the banks went up 54% from that low to the high on the 10th of February. Well, that, what, 10th of February high, and they did make a high in November last year as well. But have a look at this uptrend. You can see very clear uptrend, lots of touching, lots of riding the support line. And look at that, massive red candle breakdown. And now we're probably doing a little test. And I think the Australian banks, my clients and I are essentially, aside from an index covered call fund that we own, we don't have any direct exposure to the banks. I think the banks are relatively very overpriced. I'm not saying that they will crash. I'm just saying I don't see them as good value. This is not a place that me and my clients are personally looking to invest. On the other hand, we do have some mining. Australian mining, the XJR, the resources index, miners have been doing terrible, but the charting action on the miners looks a lot more positive. So you can see there was a high in September of 2024, and I mean, the miners have just been like, look at the high from May 2024. So what's that, 9-ish months ago? They're down 16% from there. So as the Aussie market was making all-time highs, the miners, which are part of that index, have been trending down. They have been underperforming. They are very unloved. But you can see this trend channel, and then like a little bit of a falling wedge type pattern, positive divergence again on the momentum indicator. So that was a buy for me around that level. You'd see breaks out of the downtrend, comes back to test, makes a fresh high, and now it's coming back to test again. So that's not really great price action, but for me, I think inflation is coming back, and I think this is in a breakout and it's just doing another test. I expect this, and not in a straight line, obviously, but I expect that to be the trend for the next few months. And I think this is a relatively cheaper area, especially the Australian market and in many cases the global market. There are some international mining funds that we buy, some ETFs. So for my clients and I, roughly a 10% allocation to direct mining funds, and we have a mix of those depending on the client, how much money they have, their risk tolerance. So there's not one fund we're buying. They're buying some Australian ones and some international ones. So miners looking, if I'm looking at the chart, I mean, that looks like another buy level there. But I wouldn't be too aggressive on obviously the miners carry a bit more risk than some of the other areas you can invest in. Now, the Chinese market, not much to chart there. It's just had this big pop. The Chinese are stimulating, so their market is actually holding up a little bit better in the short term, but not too much to read from the chart there. I mean, that's kind of not a buy or a sell. So my clients do have some allocation, 5% or so to the Chinese market, depending on the client, not across the board, but some clients do. But that's not a buy or really a sell for me. Maybe it's a short-term sell. If you zoom in, you can say, from the low in January, it is up 7% or so. Um, getting towards the higher end of the trading range. Not much to see there, but the Chinese are doing lots of stimulus at the moment. Now let's have a look at Nvidia, because Nvidia is, let me just go to a 2-day chart. Uh, Nvidia was previously worth about 3.6 trillion US dollars, or over 5 trillion Australian dollars. So this one company is worth was worth about double Australia's GDP. So it's a big, big part of the US stock index, along with the other big tech names, Apple, Microsoft, that sort of thing. But you can see, again, to support the thesis that the US market is top, because this is one of the key stocks, one of the key momentum growth stocks that has been driving the market higher. And what do we see here? The same thing again. We've got uptrend, we've got rising wedge, which is bearish, it's a sell signal. As the price was making higher highs, momentum indicators making lower highs, so negative divergence, which is generally a sell signal, rising wedge sell signal, massive all-time highs. I mean, from the low in January 24 to November, the stock was up 217%. I don't see how this company is worth that much, but I don't know how to fundamentally value a stock in this modern day clown world. So it's not something that I would want to be buying up here. And I've talked about that in previous videos over the last couple of months. And I thought US tech stocks were very expensive. And we're seeing one of the big names. You got a double top there as well to go with. You got negative divergence, rising wedge, double top. And then you can see it was in this trading range. So you had the former all-time highs here, then it broke out, bouncing, 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 bouncing. So that's the double top range. And then look at that big red candle there. Once the market decided, hey, we're going for a breakdown, it spills out of the uptrend, spills from the double top pattern, and then comes back, returns to the scene of the crime, touches exactly where the uptrend line was. This stuff isn't a coincidence. These stocks are trading on technicals, momentum, hopium, whatever you want to call it, and then the spill, and it makes a fresh low. Now, I know there's a green candle there, so it's come back above that, but I would say most likely what it's doing is coming back for a test of that breakdown, and then the spill to resume. So that would be the most probable, in my opinion, the most probable outcome. I don't think this is the time to be buying these stocks. This trading action doesn't look good. This looks like a massive long-term uptrend is breaking in both US tech stocks and in Nvidia itself. Classic breakdown action, return to the scene of the crime, make a new low. We'll see how it trades tonight. If it breaks above 150, if it gets back up here and makes a fresh high, then okay, I'm wrong, and that's a new uptrend starting. But I will emphasize that just because an uptrend is ending, and I would say this breakdown here, that red candle, is the uptrend ending. Just because an uptrend ends doesn't mean a downtrend has started. It just means this particular uptrend is over. For me, I'm not touching those stocks. Too risky for me, way too overpriced, but that doesn't mean they're going to crash. Just looking at the charts as objectively as I can. And of course, Tesla, we won't spend too much time on this, but Elon's gone for a bit of a spill since the 17th of December, down 43%. That's not a good sign either. But we might leave it there. 23 minutes is probably more than enough. I hope that gives you a good update on how stock markets are doing. It's a very interesting time. But the charts, you can see that charting is not a science. It's about probability and risk management. But you can see these techniques that I like, and please do watch other chartists, because there's not one way to do this. A lot of charting analysts disagree with some of these techniques that I use, and they have their own techniques. But hopefully I've demonstrated on the chart that some of these techniques can be effective for risk management, for helping us pick investments and when and where to allocate. And I'll be back again soon with another video. Thank you. If you made it this far, thank you so much for listening. Cheers.